Hi, my name is Brenton Harrison, and we're here to talk about whether you need to have your own disability insurance policy on top of what's offered at your job. Let's get started. If you work for a small business or a corporation, it's highly likely that at one point in the year, your HR representative or your employee benefits department or your employee benefit counselor is going to tell you that it's open enrollment time. And open enrollment time is a period of the year in which you can take a look at all of the offerings in terms of employee benefits with your job to decide which ones you want to participate in and which ones you want to decline. And a very common employee benefit that you find in these packages is group disability insurance. So we wanted to talk about group disability insurance today because there are a number of features of group disability insurance when compared to individually owned disability insurance that can factor into whether or not you need to supplement what you have at your job with your own policy, particularly if you're a high income earner or, like we'll cover later in this video, if you have a significant portion of your pay come through bonuses, overtime pay, or the like. So what are these areas? How do you know whether you need to purchase your own policy? And is this the right choice for you? The first thing you need to know is what disability insurance is in the first place. And I like to call it paycheck protection or paycheck insurance because disability insurance is designed to protect your ability to earn an income. It replaces a percentage of your pay if you're unable to work as a result of an illness or an injury. You have short-term insurance, which will cover you for a few weeks or a few months. And then you have long-term disability, which is typically for an illness or injury that keeps you out of work for maybe 3 months or longer, depending on your employer's definition. Now, group disability insurance is when there's essentially one master policy or one master deed where an insurance company comes and they look at the average age and health of the people at a company and they give them rates based on the employee that they can pay to protect a portion of their income. Now, because they're covering a large group of people, these companies will offer it at a lower cost when you look at what you might see in the regular marketplace. And you often will also see that the employer will participate in some of the cost for the employee. So they might cover a percentage of the premium that you might pay on a monthly basis. Now, all of that sounds great, but sometimes there are some shortfalls in this coverage that you want to be aware of, specifically if you're a high income earner or if you're in a highly specialized field. So what are some of those areas? The first thing you want to know is what is the definition of total disability? Total disability are the terms and the condition that the insurance company wants you to be in before they consider you eligible to receive your full monthly benefit. They're basically saying how hurt or ill or injured do you have to be before we are able to pay you your monthly benefit. And understanding the terms of that total disability definition are really important because some are far more liberal in terms of what you can do outside of your employer or outside of your specific task than others. As an example, you might find a company that says we consider you totally disabled as long as you cannot perform the specific task of your job, even if you are working in another job or profession. So as an example, let's say that you're a mechanical engineer. You do a lot of work with your hands, and for whatever reason, you lose the use of your hands. You're unable to be in mechanical engineering, so you start receiving pay as a part of your disability package. And maybe you retrain yourself so that you can do consulting. You can't work as necessarily a mechanical engineer, but you are earning an income outside of your previous employment. Well, because you are able to do that in spite of what you're earning elsewhere, you still meet the definition of total disability as long as you can't do the task at your original job. Conversely, you'll find some that are more restricted. They may say, we will consider you totally disabled as long as you can't do the specific duties of your task and you are not working in another profession. Which means that the section that you prove that you have the functionality to earn income in another area, your disability benefits would stop. It's really important to know whether this is something that you see in your current plan, because if it is restricted, you would certainly want to look into the option of getting your own policy on top of what you're offered through your group. Going even to more specific tasks, let's look at things like medical specialties. You might have someone and you ask them in the medical field, what do you do? And they may say, I'm a doctor or I'm a physician. And to them, that may be plenty specific. But the tasks of something like a vascular surgeon are radically different from the daily tasks of a physician that's a psychiatrist. So in actuality, that's not specific enough to tell you what they do on a daily basis. It would be more specific to say, I am a psychiatrist or I am a vascular surgeon, because that tells you what they do on a daily basis, and it also tells you what, if stripped from them, would prevent them from doing their job. If a psychiatrist has a tremor in their hand, it may not prevent them from working. But if a vascular surgeon can't use their hand, now we have a problem. Well, when it comes to individual disability insurance, you'll often find that with coverage outside of your employer, they will insure your medical specialty or your specialty in another field. So you can say to the vascular surgeon, I will start receiving disability benefits as long as I can't do vascular surgery, even if I retrain myself and do another form of medicine. So you can have someone who is a disabled vascular surgeon who's receiving disability benefits while also working as a primary care physician or a pediatrician and earning their salary there as well. However, when you have group policies, you'll often find that they will restrict how long they'll honor that specialty. So for example, they may say, we'll do that as long as it lasts 2 to 5 years. And after 2 to 5 years, we will only consider you disabled if you can't perform the task anywhere in your profession. Meaning that if you have the functionality to do another medical specialty, you can't receive that disability benefit. These are the reasons why it's important to know the definition of a total disability. The next thing to know is whether that policy is portable. Portability means that you can take that coverage with you if you leave the employer. Now, as we covered, with group disability insurance, you'll often find that the employer will help pay some of the costs that the employee incurs on a monthly basis. So what you're paying right now may not be the full cost of that coverage. And if you were to leave, even if your policy is portable, meaning you can take it with you, you likely would pay more for that coverage when you left the employer. But it is still good to have the option, in case you can't get coverage on your own, to have a group policy that you can take with you when you leave. Now, if you have a policy that's not portable and you don't plan on working for that company for the rest of your life, then you should know that if you leave 10 years from now, you would be 10 years older and now potentially in the market to have to pay for disability insurance of your own, which would have been more cost effective had you purchased it at an earlier period of time. So you want to look at your career, you want to look at the portability of your policy and try to read the tea leaves as best as you can to say, look, yes, I have this policy now, but maybe I want to start my own shop years from now. Maybe I want to start my own business. Maybe I want to be an independent contractor, at which point I would lose this coverage. And if that's the case, even having supplemental individual coverage now could be something that when you leave, you could increase later without having to worry about the impact of health changes that have occurred along the way that might prevent you from getting coverage or make it more expensive to do so. When it comes to group disability insurance, you also want to know if you would owe taxes in terms of income taxes on any benefits you would receive in the event of a disability. So we've mentioned a couple times that with many companies and organizations, they help share in the cost of their employees' disability insurance. So you might find that they cover 25% of the cost or 50% of the cost or 75% of the cost on the front end. And what that means is if you were to become disabled, that on the back end, the same percentage that they paid for would be taxable to you as income. So if on the front end they covered 25% of the cost, then on the back end, 25% of any disability benefits you receive would be taxable. Let's say that we have somebody who's earning $100,000 a year and they have a disability policy through their employer and the employer covers half of the costs. Well, maybe that policy replaces 60% of their pay in the event of a disability, and that means if they get disabled, they would get $60,000 a year in disability benefits. But since their employer covered half of the upfront cost, then half of that $60,000 would be taxable to that employee as income in the year received, meaning they actually didn't get to get even the full 60% of what they were making before. This is something that's crucial to know because you would need to know if the taxable amount that you'll receive would lower the benefit to the point where you wouldn't be able to meet your expenses in the event of a disability. Ask your employer what percentage they're covering, if any, so that you can compare it to the benefit you would receive in the event of an illness and look at your budget to know whether it's enough. For high income earners, you want to know how your group disability insurance is impacted by your high salary. There's a term called reverse discrimination, and reverse discrimination in employee benefits is a concept that basically means that the more money you make in terms of salary, the less of your employee benefits you're actually able to take advantage of because of certain limits that your employer might have put in place. And I'll give you an example of how that might come into play with disability insurance. As I said, many group policies aim to replace 60% of your pay in the event of an illness or an injury. So 60% is the percentage that they're trying to replace, but you'll also see them add a cap into how much they'll pay on a monthly basis. So for example, let's say that they said they will replace 60% of your pay in the event of a disability as long as that 60% does not exceed $10,000 a month. Well, what this means is they will replace 60% of your pay, but if you're earning so much that 60% of your pay exceeds $10,000 a month, they won't go that far. They're going to stop right at that $10,000. So let's use that as an example. $10,000 a month as a cap means that a person who's earning $200,000 or less would be perfectly fine because 60% of their pay would be $10,000 or less. They would be perfectly fine if their employer had placed a cap on benefits. But if you were earning more than $200,000 a year, then 60% of your pay would exceed the cap, which would mean that there would be portions of your income that aren't covered. If you're earning significantly more than the cap, because in some places it's $5,000 or $2,500, then you will definitely want to supplement with coverage of your own because there are likely large portions of your income that have exceeded the cap and will not be covered in the event of an illness. Adding on to that, if you're a high income earner or even someone who works off of a base salary plus commissions, you'll often find that group policies only cover base pay, base salary, and your base hourly rate. So if you're someone who gets a lot of pay from working double time or overtime, or you're someone who is a high income earner and works for a place that gives significant bonuses on which you depend year to year financially, those items would not be covered by your policy. Only your base pay would. If you have that significant earning potential, you would need an individual policy where you can show that insurance company the consistent evidence of those bonuses, of that overtime pay, so that you can have that covered in an individual policy on top of what you have through your employer. I hope this was useful to you in giving you a few key areas that you need to evaluate when deciding whether or not you need to purchase disability insurance on top of what your company offers. My name is Brenton Harrison. Again, if you haven't subscribed to our channel, I invite you to do so and to subscribe to the notifications so you know when new videos are being posted. And I will have more coming for you soon. I'll see you then.